welcome back to your Monday morning market update. I'm James, and here's what you need to know heading into the week. Stocks had a strong week. The S&P 500 gained nearly 4% and closed at a new all-time high. And it wasn't alone. The Dow Jones, the S&P 500 equal weight index, and the Russell 2000 all set records too. Technology, consumer discretionary, and communication services led the way, with the Magnificent Seven up more than 6% on the week. Energy was the one sector left behind, falling alongside a nearly 7% drop in oil prices, and other defensive sectors lagged the rally as well. Bonds caught a bid too, as both oil and treasury yields moved lower. The big story last week was the Fed. The Federal Reserve held rates steady at 3.50 to 3.75%, the fifth straight meeting without a move. What stood out was three officials dissenting in favor of a rate hike, the most hawkish dissent we've seen since 2016, and Chair Warsh offered very little guidance on what comes next. Stocks initially wobbled, and the 30-year Treasury yield pushed to its highest level in almost 2 decades on the news. Markets are now pricing roughly a 60% chance of a hike in September. Bottom line, the Fed is giving us less to work with, and that's translating into more volatility in rates. Oil remains the wild card. It spiked more than 30% in July as tensions between the U.S. and Iran escalated, pushing crude above $90 a barrel. Since then, it's reversed nearly 20%, with oil back near $75 as a planned strike was paused and talks turned toward reopening the Strait of Hormuz. We've now seen this pattern play out several times this year: an escalation, followed by de-escalation, followed by the next headline. It's a big reason interest rate volatility has stayed elevated. Big tech earnings told two different stories last week. Microsoft jumped 16% after Azure grew 43%, the largest single-day gain in market value for any stock ever. Amazon rose 10% on the back of a $200 billion cloud quarter. Meta, on the other hand, fell as heavy AI spending and a profit miss weighed on its advertising business. The market is clearly rewarding companies that can show a return on their AI investment and getting more skeptical of the ones that can't yet. On the economy, second quarter GDP growth slowed to a 1.5% annualized pace, down from 2.1% in the first quarter. But look under the hood and the picture is better than the headline. Private demand, consumer spending, plus business investment grew 3.9%, more than double the first quarter's pace. Manufacturing is picking up too, with the ISM index hitting a 4-year high in July. So the core of the economy looks healthier than the top line number suggests. Where does that leave us? We remain constructive, but selective. We're overweight quality, growth, and technology, while staying underweight areas like real estate and utilities that face more headwinds from where rates sit. On the fixed income side, we favor investment-grade credit and mortgage-backed securities over high yield, where spreads leave little room for error. Looking ahead, it's a big week for inflation data. We get existing home sales Tuesday, CPI Wednesday, PPI Thursday, and retail sales Friday, with the Fed offering less forward guidance. These numbers will carry extra weight in shaping expectations for September. If you have questions about how any of this affects your portfolio, give us a call at 843-628-1173 or email us at info@islandparkpw.com. We're always happy to talk it through. That's your Monday morning market update. Have a great week, and we'll see you back here next Monday.